You're sitting there, staring at your trading screen, and your heart is racing. Your strategy just signaled a buy, but your finger hovers over the mouse. Something inside you whispers doubt. What if this is the losing trade? What if you're about to blow your account? So you hesitate, you second guess, and then you watch as the market moves exactly where your strategy predicted without you. Sound familiar? This painful cycle destroys more trading accounts than bad strategies ever could, because the truth is, most traders don't fail because their strategy is broken. They fail because they don't trust it. Let me tell you something that took me years to understand. Trust in trading isn't about blind faith or positive thinking. It's about building a relationship with your strategy based on evidence, consistency, and brutal honesty. When you truly trust your trading approach, you execute without hesitation, you sleep soundly at night, and you stop sabotaging your own success. But getting to that point requires work. And today I'm going to show you exactly how to build that unshakable trust in your trading strategy. The foundation of trust begins with testing, but not the kind of casual backtesting most traders do. I'm talking about rigorous, comprehensive testing that leaves no stone unturned. You need to run your strategy through at least 3 to 5 years of historical data, preferably more. Why? Because markets cycle through different conditions. Bull markets, bear markets, sideways chop, high volatility, low volatility. Your strategy needs to prove itself across all these environments. When you see your system making money consistently across thousands of trades and multiple market cycles, something shifts in your psychology. You start thinking in probabilities rather than individual outcomes. But here's where most traders go wrong with backtesting. They cherry-pick the good periods or they optimize their strategy until it looks perfect on historical data. This is called curve fitting, and it's financial suicide. A curve-fitted strategy is like a custom suit tailored to a mannequin. It looks great on that specific form, but the moment a real person tries to wear it, nothing fits right. Your strategy needs to be robust, not perfect. It should work reasonably well across different time periods without constant tweaking. If you have to adjust your parameters every few months to keep it profitable, you don't have a strategy. You have a problem. Forward testing is your next critical step. This means trading your strategy in real market conditions, but with reduced size or in a simulator first. Paper trading gets a bad reputation because it doesn't involve real money, but it serves a vital purpose. It shows you whether your strategy actually works when you're making decisions in real time, dealing with slippage, spreads, and the emotional pressure of watching markets move. I recommend at least 3 to 6 months of forward testing before risking significant capital. During this phase, keep detailed records of every single trade. Entry price, exit price, reason for the trade, how you felt, whether you followed your rules perfectly. This journal becomes your proof, your evidence that your strategy works when executed properly. Now let's talk about sample size because this is where mathematics meets psychology. 1 trade tells you nothing. 10 trades tell you very little. Even 50 trades are barely scratching the surface. You need hundreds of trades to determine if your strategy has a genuine edge. Think about casinos. They don't worry about individual hands of blackjack because they know their edge plays out over thousands and thousands of hands. You need to adopt the same mindset. Every losing trade is just data. Every winning trade is just data. What matters is the aggregate result over a large sample size. When you've executed your strategy faithfully for 200 trades and you're profitable, you've got something real to trust. Understanding your strategy's statistics is absolutely essential. You need to know your win rate, your average winner, your average loser, your maximum drawdown, and your profit factor. These numbers aren't just academic exercises. They're the personality profile of your strategy. Let's say your strategy wins 40% of the time, but your average winner is twice the size of your average loser. That's a profitable system, but you need to understand what trading it feels like. It means losing more often than winning, which tests your patience and discipline. If you don't know these statistics intimately, you'll panic during normal drawdowns and abandon a perfectly good strategy right before it rebounds. Maximum drawdown deserves special attention because this is where trust gets tested most severely. Every strategy, no matter how good, will experience losing streaks. The best hedge fund managers in the world have periods where they lose money. It's not a matter of if but when. You need to know the worst drawdown your strategy has experienced historically. Then prepare yourself psychologically for something even worse. If your backtesting shows a maximum drawdown of 20%, Assume you might face 25 or 30% in live trading. When you're mentally prepared for this and it happens, you don't panic. You recognize it as an expected part of your strategy's behavior rather than evidence that everything is broken. Position sizing is the bridge between trust and survival. You can have complete faith in your strategy, but if you're risking too much per trade, one bad streak will wipe you out before your edge can manifest. Professional traders typically risk between 1 and 2% of their capital per trade. This ensures that even a long series of losses won't destroy their account. When your position sizes are appropriate, you can execute your strategy without fear because you know that no single trade or series of trades can end your trading career. This removes the emotional intensity that causes you to override your system. Consistency is the language trust speaks. Your strategy needs clear, objective rules that don't change based on your mood, the news headlines, or whether you won or lost your last 3 trades. If your entry signal is a specific technical pattern, it's always that pattern. You don't start adding discretionary filters because you're scared or greedy. The moment you begin modifying your strategy on the fly, you're no longer trading a system. You're trading your emotions, and emotions are terrible traders. Write down your rules in detail, so specific that another person could execute your strategy without asking you a single question. This documentation becomes your constitution, the law you follow regardless of circumstances. Keeping a detailed trading journal transforms abstract trust into concrete evidence. Every trade you take should be recorded with entry and exit points. The setup that triggered your signal, position size, profit or loss, and most importantly, whether you followed your rules perfectly. Over time, you'll likely notice something fascinating. Your best trades aren't necessarily the biggest winners. Your best trades are the ones where you executed flawlessly according to your plan, regardless of outcome. This realization shifts your focus from results to process, which is exactly where it needs to be. You can't control whether any individual trade makes money, but you can control whether you follow your system perfectly. Review sessions are where trust either grows or withers. Every week, sit down and analyze your trades. Look at your winners and losers not through the lens of money made or lost, but through the lens of execution quality. Did you follow your rules? Did you exit where your system said to exit? Or did you let fear or greed influence you? When you see patterns of excellent execution correlating with long-term profitability, trust deepens. When you notice that your worst-performing periods coincide with rule violations, you learn something invaluable. The system isn't the problem. Inconsistent execution is the problem. Understanding market context prevents you from abandoning your strategy prematurely. Markets trend about 30% of the time and move sideways about 70% of the time. If you have a trend-following strategy, it will naturally struggle during ranging markets. This doesn't mean your strategy is broken. It means markets are doing what markets do. When you understand that your strategy is designed for specific market conditions, you can tolerate periods of underperformance without losing faith. You recognize them as the cost of doing business, not as failures of your approach. Starting small is wisdom, not weakness. Even after thorough testing, begin live trading with the smallest position sizes possible. This allows you to build trust gradually in real market conditions where actual money is at risk. The psychological gap between simulated trading and live trading is enormous. Emotions you never felt in paper trading suddenly appear when real capital is involved. By starting small, you give yourself room to experience these emotions without catastrophic consequences. As your trust grows through successful execution, you can gradually increase your position sizes to your target level. Community and mentorship can accelerate trust building, but choose carefully. Surround yourself with traders who emphasize process over results, who share their losing trades as openly as their winners, who understand that trading is a marathon rather than a sprint. Avoid chat rooms and forums obsessed with daily profit and loss, where people brag about huge wins and hide their losses. This environment will erode your trust by making you feel inadequate and tempting you to abandon your steady approach for something more exciting. Technology helps maintain trust through discipline. Use trading platforms that allow you to set alerts based on your entry criteria, so you never miss signals. Consider using bracket orders that automatically set your stop loss and take profit levels when you enter a trade, removing the temptation to move them. Some traders even use automated execution for their strategies, which guarantees perfect adherence to rules. While I believe there's value in discretionary execution for learning purposes, automation eliminates the consistency problem entirely. Accepting losses as business expenses rather than personal failures is perhaps the most important mindset shift. Walmart doesn't close down because they had a day with more returns than sales. They understand that returns are part of retail business. Your losing trades are simply the cost of being in the trading business. When you've properly tested your strategy and sized your positions appropriately, losses are just numbers on a spreadsheet, temporary drawdowns on your journey to long-term profitability. Trust ultimately comes from alignment between your strategy and your personality. A strategy that requires watching screens all day won't work for someone with a full-time job. An approach that holds trades for months won't suit someone who needs frequent action. Your strategy needs to fit your lifestyle, your risk tolerance, and your psychological makeup. When there's harmony between who you are and how you trade, trust flows naturally because you're not fighting against your own nature. The final piece is patience. Trust isn't built overnight. It's constructed slowly, one trade at a time, through consistent execution and honest evaluation. You'll have moments of doubt. You'll face drawdowns that test your resolve. You'll watch other traders seemingly make money easier and faster. But if you stay committed to your process, if you keep gathering evidence through flawless execution, trust will solidify. And when that trust is finally unshakable, trading transforms from a nerve-wracking gamble into a systematic business where you execute your edge with confidence, knowing that if you take care of the process, the profits will take care of themselves.